All right, today we are diving deep into one of the most powerful tax strategies out there for profitable business owners, the S-Corp election for an LLC. We're tearing it down to see how it works, what its real-world performance looks like, and who it's actually for. Okay, let's get into it.
Let's just start with a number, $9,198.
And look, that is not some hypothetical made-up number. That is the real after-tax cash one consultant put back in her pocket every single year. So how'd she do it? By using a specific tax classification that the IRS offers, and it's available to almost any profitable LLC. And get this, all of that savings, it comes from just flipping a switch on how the IRS looks at your business income. This video contains affiliate links. Before we break down the exact math on how an S-Corp election saves you thousands, let's talk about the foundation. You absolutely cannot utilize this high-earner tax strategy without a properly structured business entity. Most freelancers and consultants try to scale as a sole proprietor, and they end up handing over a massive 15.3% of their income to the IRS just in self-employment taxes. That is exactly why they hit a financial wall. To make the S-Corp election and legally bypass those heavy taxes, your business first needs to be a legitimate, separate legal entity. That's where BYZ comes in. BYZ handles your entire foundational LLC formation for $0 plus state fees. They take care of the heavy lifting, your articles of organization, your registered agent service, the EIN you absolutely must have to run S-Corp payroll, and your compliance alerts. They build the exact legal framework required for you to file that S-Corp election with the IRS. This is non-negotiable if you are a high earner and want to keep more of your own money. I've put a special link in the description below. Use my link to get your LLC set up right through BYZ today and unlock some exclusive discounts and perks. Get your legal foundation handled first, and then let's get into the tax math.
Okay, so what's the actual problem this whole strategy is designed to solve? Well, it all boils down to one single, really painful tax that hits pretty much every self-employed person.
So, here's the deal. If you've got a standard LLC, the IRS looks at you and sees self-employed. And that means, on top of your regular income tax, your entire net profit gets slammed with a 15.3% self-employment tax. Think about that. You profit $100,000, and bam, $15,300 is gone before you even touch your regular income tax. It's a beast. And that right there, that's where the product we're reviewing today comes in. The S-Corp election is the direct fix for this exact problem. It doesn't ask you to earn less money. Nope. It just completely changes the rules of the game for how that money gets taxed.
All right, let's pop the hood on this thing. How does this tax election actually work? What are the mechanics?
You know, this is probably the biggest thing people get wrong about this strategy. An S-Corp is not a new company. It's just a tax classification. You're not tearing down your LLC and starting over. All you're doing is filing one form, Form 2553, to tell the IRS, hey, from now on, I want you to tax my LLC this other way. So you get to keep the legal simplicity of your LLC with the powerful tax benefits of an S-Corp. So here's the magic trick, right? The whole thing works by letting you split your income into two different buckets. Bucket number one, you pay yourself a real formal W-2 salary. And yeah, that's subject to payroll taxes, just like any other job. But, and this is the entire point, bucket number two is everything else, all the leftover profit. You take that as a K-1 distribution, and that money, it is not subject to that 15.3% self-employment tax. That's it. That second bucket is where every single dollar of savings is generated.
Okay, but here comes the big flashing warning sign. This is absolutely the most critical rule you have to follow. See, the IRS isn't dumb. They know you'd be tempted to pay yourself a salary of like $1 and take everything else as a tax advantage distribution. So to stop that, they say your salary has to be reasonable. Getting this number right is the absolute key to making this whole thing work legally.
So, what in the world does reasonable even mean to the IRS? Well, let me be super clear. It is not some simple 60-40 split you might read about on a blog somewhere. In fact, the IRS has gone on record and said they reject those percentage-based rules. Instead, they look at real-world stuff, like what's on screen here. It's all about justification. You have to ask yourself, what would I pay someone else with my skills and doing my job to run this business? The salary doesn't have to be massive, it just has to be defendable.
Okay, theory is great, but what about the money? Let's run a performance test and look at the actual hard numbers from a few different profit levels. Just look at how the savings take off as you earn more. At $75K in profit, you're saving over $3,000 a year. Hey, that's real money. But watch what happens when you jump to $150K in profit. The savings literally explode to over $8,000. And at $250,000, you're talking about almost $13,000, straight back into your bank account every single year. The more you make, the crazier the savings get.
Now, there is one little quirk you got to know about. It has to do with something called the Qualified Business Income Deduction, or QBI. With a regular LLC, your entire profit is eligible for this 20% deduction. But when you switch to an S-Corp, your W-2 salary doesn't get it, only the distributions do. So yeah, this does mean your QBI deduction goes down a bit. But, and this is the important part, the math almost always proves that the money you save on that killer 15.3% tax is way, way more than what you lose on the QBI side.
All right, so the performance is impressive, we can see that. But no product is perfect, right? For a fair review, we have to look at the downsides, the trade-offs. So let's get into the pros and cons.
You know, when you boil it all down, it's a simple trade-off. You're giving up simplicity to get major savings. The pro? It's huge. It's obvious. You slash that big self-employment tax bill. The cons? Well, they're all about complexity. You absolutely have to run a formal payroll system now, which you didn't before. And that means more admin, more deadlines, and knowing the IRS has its magnifying glass right on that reasonable salary number you picked.
Now let's put a dollar figure on that complexity, shall we? You've got to factor in these costs. We're talking about paying for a payroll service, probably higher fees for your tax preparer, and maybe more bookkeeping help. The point is, your savings have to blow past these costs to really make it a win.
And yeah, there are some hard, you must be this tall to ride restrictions. This isn't for everybody. You can't have more than 100 shareholders, they all have to be US citizens or residents, and you can only have one class of stock. This last part is why the S-Corp is usually a terrible fit if you're ever planning on getting venture capital or building a really complex ownership structure.
Okay, we've torn it down, we've looked at the performance, we've weighed the pros and cons, so what's the final verdict? Who should actually do this?
All right, we're giving this a definite green light, if you tick these boxes. And listen, the key word here is consistently. If your business is reliably clearing over $60,000 a year in profit, and your income is predictable enough to set a salary and stick to it, then the math is a no-brainer. You do have to be prepared for the admin side of things, but honestly, the tax savings are just too big to pass up.
But we're slapping a yellow light on this, meaning hit the brakes if you find yourself in these situations. If your profit is bouncing around and it's consistently under $60,000, those compliance costs we talked about, they're gonna eat up pretty much all of your savings. If your income is all over the place, or if you're just plowing every single penny back into the business, the benefits just aren't there. And maybe most important of all, you need consistent cash flow to run payroll. If you can't guarantee that, just wait.
But for anyone who got that green light, this quote really nails it. The cost of just doing nothing, it's real. If the numbers work for your business, then every quarter you wait is another quarter you're just plain overpaying in taxes. So that really leaves us with just one final question, and it's for you. Now that you've seen the full breakdown, is it time to sit down and run the numbers for your business?